we come into this week, and I know you've been very clear-eyed about this, that people were living through a crash. You started talking about this on Thursday. You said it Friday. You talking about it on First Call on Sunday. This is really one for the ages. In market history, this is the 11th worst 3-day crash that we've ever seen. The stats that are wrapped around it, it's not that great. So we'll call this the tariff sell-off, 13.56% lower over 3 days. The other ones wrapped around it are in the Depression, the financial crisis, the crash of 1929, the start of World War II, Black Monday, right? These are all historical events. And so what we've just seen is something that does not happen very often. And that begs the question, or what we are seeing today, is it a typical turnaround Tuesday, dead cat bounce, or is this the start of something else? Well, the thing about dead cat bounce is that they can run for a little while here. We've seen this in recent markets. In the global financial crisis, we had a 24% rally in stocks over the span of 46 days. In the 1973-1974 bear market, we had a 13% gain over 51 days, even though the market had already fallen by more than 20%. The first month out of a market going into the bear, if you will, produces a rally on average of 2.7% since 1950. It's 81.8% positive in terms of the return profile here. So short term, this is a bounce that we should obviously, if you're in it, you're enjoying it, it's good. But I don't know how long you can trust it to run, considering the size of it all. So gentlemen, I suppose the question I'm asking you folks here this morning is, do you think that the lows are in?
I'll give you my 2 cents.
Sure. And then I'll give you the answer.
Yeah.
Kidding.
So I don't think that we've seen the last of this kind of volatility, and I don't think we've seen the last of a sell-off. I think the lows of this move are in. I think the market is I kind of was I felt like I wrote about this the other day. The markets are too big to fail, and it takes them a little bit of time to adjust and to process everything. And in this case, it took a little bit longer than usual. It took a couple of days as opposed to a single day, just because the magnitude of the announcements and decisions. Now it's been able to process everything. And it's been able to kind of normalize things relatively quickly. I think just if you look at the way the different commodity markets have acted and reacted, including bonds, including some of the metals, including some of the in some of the equities and some of the AI stocks and everything else, I think that everything is kind of normalized a little bit now. I think that a down move from here would probably be a buy, not a sell. But I also think you'd be foolish to think that we bottomed yesterday and we're going straight up. I think that would be a huge mistake for people to make. So like I'm leaning long deltas because I came in long deltas, but I'm lightening up, if that makes sense.
Yeah,
I think
it makes perfect.
I think the play here, I think in hindsight, it was easy to say, well, it could have closed your eyes and bought anything yesterday morning. And the answer is, of course you could have.
Right.
But how the hell do you know? You know, you're down 250 after 3 straight down days. And, so are the lows in? I'm going to say yes. Are the down moves done? I'm going to say no. I'm going to say we're still going to have some violent down moves. I think they're all going to be a buy. But, knowing when to step in is going to be really challenging. And that's my take.
Mm-hmm.
Tony?
I think we've seen the highs for volatility, which would support Tom's.
I agree.
Tom's thesis there, which would support legs into this market. But I don't think we're going to get a V bottom, and I think that's the way I've been staying true the last couple of days. So I think we're going to have some chop around, and I think there'll be more tweets and more movement than we probably like. So I think if I had to put a finger to it, that overnight low on the market is probably the lowest. Yes.
Yeah, I mean, I think between the bond market, what the bond market's done and what volatility's done, the last couple of days, I think it's a pretty good bet that, a lot of this cyclicality remains. A lot of the risk is still on the table, but I think that the shock of all the tariff announcements and things like that are pretty much in place.
Yep.
I also think there's a very real possibility of some upside risk here, like in case, Trump's been known to just change his mind or whatever. Mm-hmm. So you could have be careful about some of the upside exposure.
Yep.
I think earnings coming up is going to defer to this. Earnings will defer to this high volatility that already exists. So I don't really think earnings are going to be that big a deal, other than they'll be interesting binary opportunity. But I don't think they're going to pump a lot of extra premium into earnings. And you do have April expiration coming up in 2 weeks, which is, traditionally one of the most bullish expiration cycles of the year.
The other night it was looking really sticky out there, right? You have Japanese topics and Nikkei futures lock limit down because of the market sell-off. Chinese markets see their worst day in since the global financial crisis. Yeah. You think about what happened yesterday morning, though, and Ilya brought up a great point, and kudos to him. He saw the Trump tariff announcement against China come into play, and the market sold off and didn't find new lows. And so he gets out there and starts selling puts in the market. It feels like this is that type of approach here on pullbacks. If we get more jostling and spikes in vol, unlike in 2023 and 2024, when I was the guy who's like, let's just buy out of the money calls and see where we go. This is very much what I like to call the wedding crashers mindset. Owen Wilson runs up to the stage at the end of the movie. He says, I'm not saying you have to marry me. I'm just saying don't marry him. The trades that we're placing effectively are that we're betting the market has found a low against yesterday. It's not necessarily going to go higher, but with theta decay, with the volatility coming in, it seems to be that's the favorable setup to express long delta exposure here. But what's happening in the stock market to me is not even the most interesting thing that's occurring here in the past few days. It's whatever the heck's happening in bonds. Because for all the hand-wringing about, needing to bring rates lower and wanting to refinance debt at the federal level at lower interest rates, we've seen Treasury yields now move higher than they were on Liberation Day, if you will. And that is something that really sticks in my craw, because not just being someone who's long delta exposure in bonds, but that suggests that there's a bigger force in play here on the macro level. And so yesterday I was doing some research, and into this morning I was looking over some more data, and I came across several interesting studies about trade deficits and relationships between tariff levels. And in particular, one of these studies from the Peterson Institute for International Economics looks at the relationship between global trade data and tariff levels since China joined the WTO in the early 2000s. And what they find is that countries with higher tariff levels see every 1% increase in the average tariff rate is associated with a 0.45% GDP decline in the trade balance, which is to say that tariffs are associated with increasing trade deficits. So if we think about a widening trade deficit as a result of these higher tariff levels, and we think about smaller businesses in the United States facing issues sourcing component manufacturing goods, head over to Reddit Small Business Forum right now. You're going to see a litany of complaints of people talking about how they're being slapped with like a $2,300 bill from DHL on top of the $3,000 worth of goods they just brought into the country. You enter a scenario where actually you could see what they call the J-curve effect, where initially a lot of the smaller, lower margin producers here in the United States that rely on this component manufacturing get knocked out, and initially we shrink our tax base. And so not only does the trade deficit not improve, we actually see that our budget deficit has to grow. And so the net effect of all this is, more debt for the U.S. economy. And why is this so important? Because if we're boxing ourselves in with less trade potentially moving forward, there's less of a reason for our trading partners to recycle those U.S. dollars they've just received for the trinkets they send us and put them back into U.S. debt. So we could be looking at a depletion of outside funding sources for our auctions in the short term. This is a really nasty outcome for treasuries here. And so I don't know if I have the answer. I don't know if this means short the treasury market into oblivion, but it's a dynamic that I find incredibly fascinating. The fact that treasury yields aren't lower throughout all of this, it's a major red flag for me, and it's a big warning sign.
Well, there's no question that I think the silver lining that Wall Street was that I shouldn't say Wall Street, but the silver lining that was being painted by the tariff bulls was that don't worry, because the offset is that with lower interest rates, we're going to be able to refinance debt and all this stuff, blah, blah, blah. Well, what's happened was essentially the exact opposite, as you just said, which is rates are actually a few ticks higher, and you've wiped out, trillions of dollars of market cap. So it's been an absolute disaster in that sense.
In this micro
small swatch of time. Yep, I agree. But in the micro small swatch of time, there's been it's completely backfired.
Right.
Now there's a lot of
it went way too far than anybody would have hoped or wanted.
Bonds went up too much, and then I just bought bonds this morning because I think they just came down too much. Mm-hmm. So I feel like it's easier to get long bonds than it is to get short the market right here. I think it's a much better trade. I think that spread's out of whack, but that's just me. But I don't want to get into a big economic policy discussion because I have my own feelings on tariffs and why anybody would be.
We're not talking tariffs.
No, I understand, but I'm talking just trade deficit for why I don't understand why when you basically when you're the leader of the free world as far as countries go, why you give a crap about a trade deficit. I don't even understand it. Like I really don't understand it. You're already the top of the food chain. Why do you care? Other than retribution, why do you care? Like, it doesn't make any sense to me. You own everything. Like, who cares? Like, that's the whole point. Like you already are on the top of the heap. Why would you want to mess it up? If it ain't broke, don't fix it. And it ain't broke. But when you get to having a discussion on bonds,
you hope it's because you think you're going to make it better.
Sure, of course. And your discussion on bonds, Chris, I think it's valid. The bond move, I think, is valid to have a discussion on bonds as it relates to stocks and why are they trading? Why are bonds trading where they are? Why are rates trading where they are? With stocks where they are? But the problem is that I don't think our viewers and our customers should focus at all on bonds. I think bonds, just like every other commodity right now, is a secondary play. I think stocks have so much more opportunity across the board. It's not even close.
Agreed. More importantly, let me flip it over to you. Do you think the highs are in for the year?
Yes.
I'm going to give it to you, Mr. Vecchio.
You think that? You mean the highs we made before the sell-off?
Yeah, 6,200, whatever the E-mini S&Ps were. Are the highs in for the year?
That is a very open-ended question. A week ago, we were talking about how this market is one defined by fat tails.
Well, I wanted to give you a question you weren't prepared to answer.
You think there?
Yeah, I'm thinking through this out loud.
I'm asking Chris first, as he asked me.
I'm just curious what you think.
I will answer. Go ahead, Chris.
I can't say no right now. And that's just not because I'm a permabull. It's because if you get a gigantic free trade zone among North America and Europe and parts of Asia, which low tariff rates.
So you're saying if this play works, the highs
already failed. It can't work
in this short swap of time. I'm just trying to play devil's advocate.
I understand. I'm just saying the play's already failed.
Yeah,
like you can't
in this short swatch of time.
You can't lose all your money.
So I'm going to ask you the question next, and then I'm going to go to the answer.
Okay,
Chris. I'm asking you. I'm putting you on the spot.
Yeah,
like you put me on the
spot. The probabilities of it working out, in my opinion, are low. But if it were to work out, this is a market that would be.
That's not an answer. I'm asking
your
opinion. Are the highs in for the year? Chris's opinion.
Based on the information I have now, yes.
Thomas.
Okay.
I'm gonna say no. I mean, there's 1,000 E-mini S&P to go to your point.
Yeah.
Expected move, which would put us at the high end of right. It would put us like right there.
I'm gonna make it really simple for you.
So I don't think we hold the highs, but I think we can see them.
Are the highs in like going forward?
6,200.
No, probably not. I think they could go easily higher than that. But the reason they go higher than that is because we have an incredible strong economy and a machine. Here, the answer is, are the highs in? I don't think they are. Are was this tariff play, was this whole play a positive or a negative, or will it turn out to be a positive? And the answer is it was an absolute disaster no matter what happens. It's over already. You can't take 20% out and then go rally back up and say, well, you see, it still worked out, because it didn't work out. It absolutely did not. It's a total failure. But could the highs still be higher? Of course. And in fact, I think they will be. And I think it's possible at the end of the year that we've already seen, it's possible we've seen the high and the low already. That's totally possible. But I do think
volatility, it's telling you that we could do that. We could hit both of them easily again, especially to the downside.
Yeah. 4,800 to me is a number that I didn't think we were going to get to this year. I will tell you that. And I don't know if we actually traded 4,800 or whatever, but it's a number I didn't think we can get to.
Just over, but sure.
Just over.
It doesn't matter. We're all friends.
I could easily see us getting to 6,200 again. No problem. But it's not.
It should be a problem because only $1,000 point expected.
That's 6,200.
Right. That gets us right all on one side, Tom. I mean,
I know. I'm just saying. Yeah. I could see it. Sure. I'm definitely not ruling that out. Definitely not.
I'm looking at the 267 data expiration, December 31st call. Long the 6,400, short the 6,500.
I mean, it wasn't
layout,
long ago you bought the 8,000 calls or something like that. What calls did you buy?
Oh, that was back in September when I was buying the 6,100 calls, which were hits. They were hits. So different market, different times. But there's that part of me that can't hold out and say, if for some reason this does all work out, we're not going to get the manufacturing boom that people expect to see. I know that experience firsthand with startups. I'll tell you, though, that you're going to have a lot of capital that can flow into the country, and that could really juice the markets here. But that is not necessarily on anyone's bingo card. Trump did say something yesterday, though, however. He said in his speech talking with Netanyahu, we want open borders, which gobsmacked me. But if you're getting open borders for trade, it means that you have capital that can flow anywhere. And where else would you want to flow except for the United States in that world? Pipe dream, but can't rule it out.
We'd be having a different conversation if the market was down 4% today than we're having a conversation with it up 4%. I think we get sucked into looking at things so bright, so tight into what's happening into the here and now. I think we have to take a step back for a quick second and just show that we have 1,000-point expected move. Opportunity abounds, just like it was happening on Friday, and I talked to you on Sunday night. You have opportunity here today on both sides of the market to do something. The worst thing you can do is do nothing. We've waited for this for so long. Do something.
Sure.
Put it out there, but put it out there in an intelligent way with a high probability trade. Sorry, go ahead. Oof.
What's the expression? Fortunes are made in bear markets. They become liquid in bull markets.
Okay.
Thank you, Mr.
Respect the bear, respect the bull.
Yeah, I could easily see. I would have no issue with new highs.
Beautiful.
I think it'd be fun I think it would be. Well, listen, I'm a little bit selfish here too. In our business, you know damn well that we want to see new highs.
Yeah, bull markets are good for customers just because listen to all the noise you've had about 401ks and everything else. Yeah, sure. I mean, but ultimately the market has positive drift. It rewards those that
100%.
take risk. So I want people to take risk. That's what like I told my daughter on Thursday, Friday, and Monday, if not now, when? And that's exactly what I said to you and everybody else. If not now, when?
Does she listen to you?
She did listen, but I don't think she listened as much as she's supposed to. But she's always been my other child.